Friday, close analysis, buying the dip. Friday, February 13th, 2026, 3:59 p.m. Eastern. The bell is seconds away. Silver is crushed at $76. Panic is everywhere, and retail is dumping like it's the end. But then, the final 60 seconds hit, and something doesn't make sense. The price stops falling, yet the volume suddenly explodes. Not small orders, not fear-click selling, but heavy, controlled buying. The kind that only shows up when someone has a plan and a reason. So the real question isn't, why did silver drop? The real question is, who bought the close, and what are they expecting when futures reopen Sunday at 6 p.m.? Because if this is a setup, Monday won't open at $76. It will open somewhere else, and the people who sold in fear may spend the next week chasing what they just handed away. Now here's the part nobody is ready for. What if the weekend headline is the trap, and the tape is the truth? Welcome to Market Metal. If you're watching this, and you're over 50, you already know how the world works. You've seen promises change overnight. So do one wise thing for yourself. Subscribe, not because of hype, but because you deserve to stay prepared. And tell us in the comments, where are you watching from? The setup, what the Friday close is signaling. He does not begin with Monday, he begins with Friday. On Friday afternoon, the market looked weak. Prices had fallen earlier in the day. Headlines were negative. Commentators were cautious. Retail traders were tired. It looked like another soft close into an uncertain weekend. But when he studies markets, he does not focus on emotion. He focuses on structure, and structure often hides in the final hour of trading. At 3 p.m. Eastern, volume began to change. The price was still drifting lower, but something subtle happened. The decline slowed. The candles became smaller. The pace of selling did not accelerate, even though fear in the headlines did. For many inexperienced traders, that detail would seem minor. For institutional observers, it was critical. He looks at closing behavior because the closing price sets the tone for the weekend narrative. It influences how news outlets frame the story. It shapes retail psychology. But institutions do not trade narratives. They trade positioning. Between 3:30 and 4 p.m., volume increased. Not chaotic volume, not erratic prints. It was steady, controlled activity. The price stopped falling in proportion to the volume. That relationship matters. When heavy volume comes in and price does not collapse, it suggests absorption. Someone is taking the other side of the selling. They understand that markets are auctions. When sellers become aggressive but price does not break lower, it means buyers are willing to absorb supply at that level. That is not retail behavior. That is structured capital deployment. For business leaders and serious decision makers, this is the first warning. Friday's closing print is not just a number. It is a positioning snapshot. The second element is timing. The market is entering a 24 to 72-hour window before CPI. Inflation data is not just another report. It directly influences expectations about interest rates, bond yields, and currency strength. Those variables drive capital allocation across equities, commodities, and fixed income. He understands that institutional funds rarely wait until the morning of CPI to act. They begin adjusting exposure ahead of time. They hedge, they rebalance, they reduce risk, or add selectively. That positioning often shows up late in the prior week. This is why Friday's final hour matters more than Monday's open headline. Now he shifts to mechanics. When futures markets close on Friday, participants lose the ability to trade until Sunday evening. That creates a gap window. If new information develops during that time, price does not adjust gradually, it adjusts instantly at reopen. He explains this simply to young entrepreneurs in the audience. Imagine a business that closes its doors for 2 days. During that time, demand changes sharply. When it reopens, prices must adjust immediately. There is no slow negotiation. The first transaction resets the value. Markets operate the same way. If positioning into the close shows strong accumulation, and no new negative information appears over the weekend, the path of least resistance can shift upward at reopen. Shorts who sold into weakness may face immediate pressure. They must buy back contracts to limit losses. That buying creates momentum. This is not speculation. It is structural reflexivity. He studies past CPI weeks. Frequently, volatility compresses into Friday. Traders reduce exposure. Liquidity thins. Then, Sunday evening sees expansion. The direction depends on positioning, not on emotion. The key insight is this. Markets move most violently when positioning is crowded on one side. If too many traders sold late Friday expecting further weakness, a small upside catalyst can force rapid covering. That covering is not optional. It is mechanical. Margin rules require it. Risk managers demand it. This creates the possibility of a gap, but he does not make predictions. He assesses probability. He asks 3 questions. First, was the Friday weakness driven by new structural information or by temporary narrative pressure? Second, did the final hour show continued distribution, or did it show stabilization and absorption? Third, how sensitive is current positioning to CPI expectations? When he evaluates those questions, he sees asymmetry. If CPI surprises to the upside, inflation expectations may rise. That can pressure bonds and support hard assets. If CPI comes in softer, rate cut expectations may return. That can weaken the dollar and support risk assets. In both scenarios, volatility increases. The market is not calm, it is compressed. For business owners and capital allocators, this is not about day trading silver or any single asset. It is about understanding liquidity waves. Liquidity does not disappear, it shifts. When major data approaches, liquidity concentrates around key levels. Friday's close becomes a pivot point. He emphasizes something critical. Retail traders often interpret a weak Friday close as confirmation of a downtrend. Institutions often interpret it as an opportunity to reposition before a catalyst. The difference lies in time horizon. Retail asks, what happened today? Institutions ask, what will happen when the market reopens? This difference creates the gap. He also explains the psychological dimension. Humans anchor to the last visible price. If the market closes at a lower level, fear dominates over the weekend. Social media reinforces that fear. By Sunday evening, many participants expect further downside. If the reopen price is higher than the close, the shock is amplified. Shock creates volatility. Volatility creates forced decisions. Forced decisions create opportunity for those prepared. He returns to CPI. Inflation data is not just a statistic. It influences monetary policy expectations. Monetary policy influences the cost of capital. The cost of capital influences business investment, corporate earnings, and asset valuations. A single data point can alter forward guidance. Therefore, large funds cannot ignore it. They must manage exposure before it arrives. Positioning data suggests that funds reduced exposure aggressively earlier in the week, but absorbed supply into Friday's close. It implies recalibration. Not panic? Recalibration? This is the calm before expansion. He reminds his audience that markets rarely move in straight lines. They move in compression and release cycles. The 24 to 72 hours before CPI represent a compression window. If Monday opens with a gap higher, it signals that Friday's close was accumulation, not distribution. If Monday opens flat but holds key levels, it signals stabilization. If Monday opens sharply lower with heavy continuation volume, it signals that absorption failed. Each outcome contains information. He does not encourage emotional reaction, he encourages preparation. Serious decision makers define levels in advance. They define risk tolerance in advance. They understand that gaps can move 2 to 4% instantly in certain markets. They avoid excessive leverage before data events. They protect capital. The strategic warning is simple but urgent. Do not misread Friday's close as a conclusion. It may be a setup. He concludes part 1 with a measured observation. The market is entering a narrow window of elevated sensitivity. The final hour of Friday suggested that larger players were not exiting in panic. They were positioning. Whether that positioning leads to a 24-72-hour gap up before CPI depends on what unfolds between now and the reopen. But the structure is present. The conditions are aligned. For those watching closely, Monday is not just another session. It is a test of whether Friday's closing behavior was noise or signal. And in markets, the difference between noise and signal determines who reacts and who prepares. The institutional layer, who is positioned, and why he does not look at headlines first. He looks at positioning. Because when markets move sharply before a major data release like CPI, it is rarely because of emotion alone. It is because someone, somewhere, is forced to adjust risk. And when forced adjustment meets thin liquidity, price moves faster than logic. As Sunday evening approaches, he studies one number more carefully than price itself: open interest. Open interest tells him how many contracts remain open. It tells him how crowded a trade is. It tells him how much fuel is sitting in the system waiting to ignite. If volume increases but open interest falls, that means liquidation. Positions are being closed. Risk is leaving the market. But if volume increases and open interest remains stable, or even rises, that means something else. It means positions are changing hands. Weak holders are selling. Stronger hands are absorbing. That distinction matters more than any headline. On Friday afternoon, the market did not collapse under pressure. It stabilized. Heavy volume printed without proportional downside extension. For the untrained eye, it looked like exhaustion. For institutional analysts, it looked like transfer of ownership. He explains this carefully to his audience of business professionals. When a business changes owners, the sign outside the building does not change immediately, but control is shifted. The same is true in markets. Price may not move dramatically at first, but if ownership shifts from short-term traders to longer horizon capital, the next move can be sharp. Now he turns to the short side. Short sellers borrow contracts and sell them, hoping to buy back at lower prices. It works well in stable environments. But ahead of CPI, stability disappears. If CPI surprises in either direction, volatility expands. Shorts understand this. Their risk is asymmetric. Losses are theoretically unlimited. If price gaps higher Sunday night, they cannot wait patiently. Margin requirements do not negotiate. Brokers close positions automatically when thresholds are breached. He studies the distribution of leveraged positioning. In pre-CPI environments, hedge funds often reduce gross exposure, but smaller speculative accounts sometimes lean heavily in one direction. If sentiment turned negative late Friday and retail short exposure increased into the close, that creates fragility. Fragility creates acceleration. He then shifts to liquidity windows. From Friday's close until Sunday evening, markets are technically closed, but information is not. News flows continuously. Geopolitical developments do not pause. Economic leaks circulate. Central bank commentary spreads globally, yet participants cannot respond in real time. This creates what he calls latent imbalance. If new information contradicts Friday's narrative, there is no gradual repricing. The first trade, Sunday night, becomes the adjustment mechanism. The first print often occurs in thinner liquidity than normal weekday sessions. Thin liquidity amplifies order flow. If institutions accumulated into weakness on Friday, and if weekend developments fail to justify the sell-off, they may press the advantage early Sunday. Shorts, facing immediate drawdowns, cover. Momentum algorithms detect upside impulse and add to it. A controlled stabilization becomes a vertical reaction. He reminds young entrepreneurs watching that markets are not emotional creatures. They are mechanical systems governed by incentives and constraints. Institutions do not buy because they feel optimistic. They buy because risk-reward becomes favorable. If they believe downside is limited ahead of CPI while upside volatility is expanding, they accumulate. He also studies derivatives markets. Options pricing often reveals expectations before futures do. Implied volatility tends to rise ahead of CPI. But if call option demand quietly increases while price drifts lower, that divergence is meaningful. It suggests preparation. Now the suspense deepens. He asks a direct structural question. If Friday was true distribution, why did price stop accelerating lower despite strong volume? Sustained distribution typically produces cascading lows. It creates air pockets. It does not create tight stabilization zones on expanding volume. Absorption, however, does. Absorption is silent. It does not announce itself. It does not trend loudly. It sits. It waits. It builds a base. He reviews historical CPI weeks. In several prior cycles, markets dipped late Friday before inflation data. Commentators framed it as weakness. But the reopen printed higher because positioning was misaligned. Those who reacted emotionally were trapped. Those who analyzed structurally were prepared. He does not guarantee repetition. He studies probability. The most powerful moves occur when narrative and positioning diverge. Right now, narrative suggests caution. Headline tone is defensive. Sentiment surveys show rising uncertainty. But positioning metrics suggest that stronger capital did not flee into the close. That divergence is tension, and tension resolves with movement. He explains why institutions might prefer this setup. If CPI surprises to the upside, inflation hedges gain appeal. If CPI surprises to the downside, rate cut expectations strengthen. Both outcomes can produce volatility. Accumulating before the event offers asymmetry. The key risk is continuation lower before CPI. But institutions manage that risk differently than retail. They scale, they hedge, they allocate in layers. They do not react in single blocks. He contrasts this with emotional trading. Retail participants often reduce exposure at the worst moment because weekend uncertainty feels uncomfortable. They seek safety in cash without evaluating whether price already reflects worst-case assumptions. Institutional capital seeks mispricing, not comfort. Now he introduces the most important layer, time horizon. Retail thinks in hours. Institutions think in weeks. Sovereign funds think in quarters. The larger the capital base, the longer the time horizon. A $2 move matters greatly to a leveraged day trader. It barely registers for a sovereign wealth fund building a structural allocation. If the latter absorbed supply Friday, their intention is not a short-term scalp. It is positioning ahead of macro inflection. He pauses on this point. Markets do not move because small traders panic. They move because large traders reposition. The question for Monday is not whether sentiment is negative. The question is whether positioning is vulnerable. If shorts are crowded and longs were reduced prematurely, the path of least resistance shifts upward. And when resistance shifts, price does not drift. It gaps. He concludes part 2 with a controlled warning. The 24-72-hour window before CPI is not a casual period. It is a positioning battlefield. Liquidity is thinner. Incentives are sharper. Risk managers are more active. Friday's close hinted that stronger hands may have stepped in quietly. If that is correct, Sunday's reopen will not be calm. It will reveal whether ownership truly changed or whether the market was only pausing before a deeper decline. And that answer arrives not through commentary, but through the first print when futures reopen. The catalyst? CPI as the trigger, not the story. He does not fear CPI, he respects it, because CPI is not simply a number released at 8:30 a.m. It is a signal that travels through the entire financial system in seconds. It touches bond yields, it moves currencies, it reshapes rate expectations, and through those channels, it changes the value of everything else. But here is what most people misunderstand. CPI itself does not create the move. Positioning around CPI creates the move. And positioning is already in place before the data ever prints. As Sunday night approaches, he studies the bond market first, because inflation does not begin in commodities. It begins in expectations. If traders believe CPI will come in hot, they adjust yields upward in advance. If they believe inflation is cooling, they price in lower rates. Those expectations filter into currency markets. The dollar strengthens or weakens, and from there, asset prices react. Silver, equities, risk assets. They are not isolated. They are downstream of monetary expectations. He explains this in plain terms. If inflation surprises to the upside, the central bank faces pressure. Higher inflation means tighter policy for longer. Tighter policy pressures debt markets. When debt markets strain, volatility increases. And when volatility increases, capital seeks protection. If inflation surprises to the downside, rate cut expectations return. Liquidity assumptions improve. Risk appetite expands. Again, volatility increases, just in a different direction. In both cases, CPI is an accelerant. The question is not what CPI will say. The question is how crowded the market is before it speaks. He studies the derivatives market carefully. Options volume often increases ahead of CPI. Implied volatility rises. But when implied volatility rises while price compresses, tension builds. That compression can resolve violently. He observes that late Friday stabilization created such compression. Short-term traders reduced exposure, but longer-term positioning did not fully unwind. That leaves pressure beneath the surface. He then presents three structural scenarios. Scenario A, Sunday night opens higher, the market gaps up before CPI. That suggests that Friday's selling was absorbed. Shorts begin to cover into thin liquidity. Momentum builds into the Asian session. By Monday morning, price is already above key resistance levels. In this scenario, CPI becomes confirmation rather than catalyst. If CPI aligns with the move, the rally accelerates. If CPI contradicts it slightly, the move may pause but not collapse because positioning has already shifted. Scenario B, Sunday night opens higher, but the move stalls. Early buyers push price upward, but liquidity thickens into Monday morning. The gap narrows, participants wait for CPI. In this case, CPI becomes the true trigger. Volatility compresses into the release. When the data prints, expansion follows. The direction depends on whether expectations were misaligned. Scenario C, Sunday night opens flat or slightly lower. Friday's absorption fails. Price tests prior lows. Market participants become defensive. CPI then determines everything. A hot print could deepen weakness. A cool print could reverse the entire structure in minutes. He emphasizes something critical for decision makers. The highest volatility often occurs when markets are least prepared for it. If sentiment is uniformly cautious and positioning is defensive, upside surprises travel farther. If sentiment is overly optimistic, downside shocks cut deeper. Right now, sentiment is cautious, but positioning data suggests not everyone exited. That divergence is suspense. He then turns to time compression. Between Sunday evening and CPI release lies roughly 24 to 72 hours. That window is small in calendar terms, but enormous in capital terms. Hedge funds rebalance. Corporations hedge currency exposure. Asset managers adjust duration risk. Every action shifts liquidity. Small changes in liquidity create disproportionate moves when leverage is present. He reminds his audience of historical parallels. In prior inflation cycles, markets often staged unexpected pre-CPI moves. Commentators misinterpreted them as noise, but they were signals of repositioning. For example, in several prior years, bond yields moved sharply before inflation data confirmed the trend. The equity market reacted afterward, not before. Those who waited for confirmation often entered late. This is why he describes CPI as the trigger, not the story. The story is monetary constraint. Inflation remains structurally elevated relative to long-term targets. Debt levels are historically high. Interest expense consumes increasing portions of government budgets. Policy flexibility is narrow. In such an environment, even moderate CPI surprises create exaggerated reactions because the system is sensitive. He explains this carefully for entrepreneurs and business leaders. When a company operates with minimal cash reserves and high debt, even small revenue shocks matter. The same applies to the macro system. When debt to GDP is elevated and fiscal flexibility is limited, small inflation shifts create large market reactions. CPI is the revenue report of the monetary system. He then returns to the gap theory. If Sunday night produces an upward gap, It signals that market participants believe the risk-reward favors upside volatility into CPI. It suggests that shorts are vulnerable and that downside is limited. If Sunday night produces weakness, it signals caution and risk aversion. In both cases, Monday is not random. It is the market expressing expectations about CPI before CPI arrives. That is the power of anticipation. He warns against one mistake. Retail traders often focus exclusively on the data print itself. They prepare for 8:30 a.m. Wednesday, not for Sunday 6:00 p.m. They ignore the pre-positioning window. But professionals understand that large moves often begin before the event. By the time CPI confirms a trend, much of the move may already be priced in. This is why the 24 72-hour window is strategic. He describes the emotional trap. If Sunday gaps higher and retail hesitates, waiting for confirmation, they risk entering after the initial squeeze. If Sunday gaps lower and they panic, they may sell into a temporary flush before CPI reverses the move. Emotion reacts to price. Strategy anticipates positioning. He closes part 3 with a calm but firm warning. CPI is approaching, volatility is compressing, liquidity is thinner than it appears, and beneath the surface, capital has already begun to reposition. When the first print hits Sunday night, it will not merely reflect price. It will reveal expectation, and when CPI finally arrives, it will not create volatility from nothing. It will release the pressure that has been building quietly for days. The only question is which side of that release investors choose to stand on. Strategic implications, the decision window before the move. He does not see Monday as a trading session. He sees it as a decision window. Between Sunday evening and the CPI release lies a narrow corridor of time where capital must choose direction, not emotionally, structurally. And in that corridor, hesitation is costly. By now, he has studied the positioning. He has examined the closing structure. He has assessed the volatility compression ahead of CPI. What remains is execution. For serious decision makers, fund managers, entrepreneurs allocating surplus capital, operators managing risk exposure, the question is not, will it gap up? The question is, what will they do if it does? He explains something most retail participants never fully internalize. Professionals prepare for outcomes, not predictions. They define thresholds. If Sunday opens above Friday's high and holds that level for 2 consecutive hourly closes, that is confirmation of strength. If it gaps up and fails within minutes, that is a trap. If it opens lower, but recovers key levels before the Asian session closes, that signals absorption still active. These are not guesses. They are conditional responses. He emphasizes risk management first. Ahead of CPI, leverage becomes dangerous. Margin sensitivity increases. Volatility expands faster than liquidity can absorb it. Even correct directional views can be destroyed by excessive position sizing. The professional understands this. They scale exposure. They protect downside. They preserve flexibility. He explains it in business terms. A company entering an uncertain quarter does not deploy all cash reserves at once. It stages investment. It protects liquidity. It prepares contingency plans. Markets require the same discipline. Now the suspense deepens. If Sunday night opens higher, short sellers will face immediate stress. Their positions will deteriorate before most retail investors even log in. Risk desks will calculate exposure in real time. Some positions will be closed automatically. That forced buying can create an upward cascade, but here is the hidden layer. Institutions that accumulated into Friday's close may not chase the move aggressively. They may allow short covering to do the work. They may let price stretch into Monday morning. And then, once liquidity improves, they may reassess. That means the first hour does not guarantee the full outcome. It reveals vulnerability. He outlines 3 execution principles. First, do not react to headlines before price confirms structure. Weekend narratives are noise unless validated by order flow. Second, respect key levels. If a gap holds and builds, it indicates demand is genuine. If it fills quickly, it signals false positioning. Third, protect capital over ego. If a thesis fails early, exit. Do not rationalize. He speaks directly to the entrepreneurs watching. Many business leaders confuse conviction with stubbornness. In markets, stubbornness destroys capital. Conviction must always submit to price. He then zooms out. The larger macro backdrop remains fragile. Debt levels remain elevated. Interest expense pressures, fiscal stability. Central banks operate within narrow policy corridors. Liquidity injections, repo operations, and emergency facilities quietly sustain financial plumbing. In such an environment, volatility is not an anomaly, it is the norm. This means the 24 72-hour window before CPI is not isolated. It is part of a broader cycle where markets oscillate between compression and release. He reminds his audience that wealth preservation requires anticipation, not reaction. If Monday gaps up and sustains strength, it signals that capital believes inflation risk remains mispriced. If it gaps down and accelerates lower, it signals defensive posture ahead of CPI. Either way, the move provides information. Information, not emotion, drives strategic capital. He introduces a critical psychological insight. Retail participants often seek perfect entry points. They wait for confirmation. They wait for clarity. But clarity arrives after movement. By the time uncertainty disappears, the asymmetric opportunity has already passed. Professionals act when probability shifts, not when certainty arrives. He describes the asymmetry window. If downside risk into CPI appears limited due to prior selling, while upside volatility risk appears elevated due to positioning imbalance, that window favors accumulation, not because of hope, but because of skewed risk reward. However, if downside acceleration breaks structural support levels, the window closes. Discipline demands exit. This is not about predicting inflation. It is about managing capital through uncertainty. He then addresses volatility directly. If CPI surprises strongly, Monday's gap may only be the beginning. Large moves do not happen gradually. They happen in phases: initial repositioning, then confirmation, then momentum. The first phase begins Sunday night. The second phase unfolds around CPI. The third phase determines medium-term direction. He warns of a common error. Many investors focus only on the second phase. They prepare for the CPI number but ignore the repositioning phase that precedes it. That is where risk and opportunity first appear. Sunday evening is not a quiet reopening. It is a structural checkpoint. He slows his tone intentionally. This is not a time for overconfidence. It is a time for precision. If the market confirms strength early, exposure can be increased methodically. If it fails, risk can be reduced quickly. Flexibility is power. He ends with a sober conclusion. Monday's open is not about silver or equities or any single asset. It is about liquidity alignment. If capital that absorbed Friday's selling remains committed, the gap-up scenario becomes self-reinforcing. Shorts cover, momentum builds, CPI amplifies. If that capital retreats, the structure collapses, and the market reprices downward before the data even arrives. Either way, the 24-72-hour window is decisive. He does not claim certainty. He claims preparation. Because in markets, those who prepare before the move survive the volatility. Those who wait for clarity pay for it. And when futures reopen Sunday night, the first print will not just be a number. It will be the market declaring which side of the imbalance is about to give way.